Hi, welcome back. Welcome to the part 2 video of Sharpe Ratio. If you are watching this video directly without watching part 1, then I strongly recommend you should watch part 2 because in part 1 I have explained all the basics of Sharpe Ratio. I've explained how to calculate the returns of a stock, how to calculate the risk of a stock, and using the returns and risk, how to calculate the Sharpe Ratio. Okay, the higher the Sharpe ratio, the better is what I have explained in the previous video. In this video, we're going to learn how to compute the returns for a portfolio. Portfolio is nothing but a group of stocks together. So in this video, we're going to learn how to compute the returns for a group of stocks. Similarly, we are also going to learn how to compute the risk for a portfolio, and using the returns of the portfolio and risk of the portfolio, we will calculate the Sharpe ratio for the portfolio. In addition to that, I will also explain how to optimize your portfolio. Meaning, let's say you have $100 as an investment for a portfolio. Now, usually if you have 5 stocks in a portfolio, you wouldn't really know how to allocate what percentage of money to each stock. Usually people would do equal allocations. But in this video, I will explain how to optimize the allocation. Basis the allocation, you can maximize your returns and lower the risk. So that's what we're going to learn in this video. So there are 3 important things that you're going to learn in this video: how to calculate the returns of a portfolio, the risk of a portfolio, and how to optimize the portfolio. Let's quickly get started. Now, quickly go ahead and look into calculating the returns, risk, and the Sharpe ratio of a portfolio. Let us, for the sake of example, assume that we have 5 stocks in our portfolio. The very first step that we need to do in this example is we need to first understand how much allocation we are doing for each of the stocks. Okay. You may not do equal allocations. Let's say you have 100% or $100 to invest in a portfolio, right? Now, you're not usually going to do 20%. You can do 20% each, but sometimes mostly people prefer to invest much in a very solid stock, a little in a risky stock, a moderate amount in a stock that gives moderate amount of money. So assume that you have done your allocation. Make sure your allocation is summing up to 100%. If you take this allocation here, we're investing 40% in stock 1, 25% in stock 2, 5% in stock 3, 20% in stock 4, and 10% in stock 5. If I sum all these percentages, it sums up to 100%. So this is the very first step that we need to do. Step 1, break your allocation among the different stocks that you have in your portfolio. Step 2 is going to be calculate the returns for stock 1. We need to compute the returns for each of the stocks that we have in the portfolio. Since we have 5 stocks in our portfolio, we have to compute returns for each of the stocks. And in step 3, we have to compute the standard deviation. Standard deviation is nothing but the risk of the stock. So we have to compute the returns, and then we have to compute the standard deviation for each of the stocks. This is step 2 and 3. Let's assume for a moment that for stock 1, we have got 16% returns and 12% as a risk. And stock 2, 10% returns and 13% risk. Stock 3, stock 4, stock 5, these are our returns, and these are our standard deviation numbers. I would use standard deviation and risk interchangeably since they both mean the same. Okay. Now, we've said we are going to allocate 40% for stock 1, 25% for stock 2, 5% for stock 3, 20% for stock 4, and 10% for stock 5. Now, using these numbers, we can easily compute and calculate the returns and the risk for a portfolio. So it is very simple. We have to use weighted average method to calculate the returns. What do I mean by weighted average is, let's first do weighted average for returns. We're going to take stock 1. We're going to say 16% into 40%. Plus, since we're doing it for returns, let's only look at these numbers for a moment. 10% into 25% plus 16% into 5% plus 24% into 20% plus 35% into 10%. If you do the math, okay, you get a number. That number is going to be the returns for portfolio. Okay, similarly, now let's take the risk. We need to do a weighted average risk here. We're going to take 12% for stock 1 into 40% allocation plus 13% for stock 2 into 25% allocation plus 9% into 5% plus 12% into 20% plus 11% into 10%. Now, if you do the math, you get a number. This number is going to be your risk percentage of a portfolio. So as I've done the calculations, here are the numbers. I have gotten 18% returns when I did the weighted average calculations. See here, 40% into 16%, 25% into 10%, so on and so forth. The returns I have gotten is 18%. So this 18% return, the return of the entire portfolio. Similarly, if we do the calculation for risk, I have gotten 12% as a risk number for the entire portfolio. So the process is very simple. If I have to explain, what you need to do is, first you need to understand how many stocks are there in the portfolio. In our example, we had 5 stocks. So what we have done first, the first step we have done is we have done the allocation. And the second step is we have calculated returns for each stock. And the third step is we have calculated risk for each stock. And then we used weighted average formula to calculate the returns and risk of a portfolio. Now that you have the return and risk of a portfolio, all you have to do is divide your returns by risk for the portfolio and you get the Sharpe ratio for the portfolio. Let me do a quick recap. In part 1 of the video, we've learned how to calculate the returns and risk for an individual stocks. Using that knowledge, in this video, we have learned how to calculate the returns and risk for a portfolio. The only thing that we have used in calculating the returns and risk for a portfolio is the use of weighted average. Hope that was helpful. Now we are going to see how to optimize the portfolio. So what do I really mean by optimizing the portfolio? Let's take the same portfolio example we have here. We've received returns for this portfolio as 18% and the risk for this portfolio as 12%. Now, let's first calculate the Sharpe ratio, and I'll explain in a moment why we are calculating the Sharpe ratio and using the Sharpe ratio how we are going to optimize it. Now, let us assume 3% as a risk-free rate, because as you know, for us to calculate the Sharpe ratio, you need to first remove the risk-free rate from your returns, which is also called as excess returns. That means 18 minus 3 divided by the whole risk. It means 15 by 12 and it gives us a number of 1.25. The Sharpe ratio is 1.25. And I have mentioned the higher the Sharpe ratio, the better. Now, when we are saying optimizing the portfolio, what we are really talking about is, can we increase the Sharpe ratio number? Is there a way that by changing these allocation numbers here, can we get more returns than 18%? And can we reduce the risk lower than 12%? That's what we're trying to do. That's called optimization of the portfolio. So what we are really going to do is we're just going to do a trial and error by changing these numbers. Now there is a process how to do it. It's a simple process. It's not complicated at all. That's what I'm going to explain. As a very first step, we are not going to assume that we are going to allocate 40, 25, 5, 20, 10 here for the stock 1, 2, 3, 4, 5. We will start by assuming that we are doing equal allocations. So we are going to assume that we are going to start with 20% allocation for each stock. Then we will compute the risk of this portfolio. We're going to compute the returns of the portfolio, and then we will compute the Sharpe ratio for the portfolio. Okay, so that is going to be our baseline. So we will first assume having equal weightage of 20% each, what would be our returns, what would be our risk, and what would be the Sharpe ratio. Once we get that number, that is when we have to do trial and error by changing these numbers and compute the Sharpe ratio. And it's easy. We are not going to compute the numbers by pen and paper because it's humanly impossible. We are going to use a function within Excel called solver to solve the mathematical problem that we're going to throw at it. I'm going to show that in an Excel file to you. I'm going to copy this table here into an Excel file so that we can use Excel and compute the numbers. I've already copied it here. So stock 1, 2, 3, 4, 5. I copied the returns for each individual stock and the risk for each individual stock. Allocation, as I said, since we're trying to optimize it, we will do equal allocation. Okay, 5 stocks, 5 into 20, 100%. So I'm going to do 20% for each. Now we are going to compute the portfolio returns using weighted average. I'm going to multiply 16% into 20%. I'm going to do the same here. And then I'm going to total this up. So with equal allocation, 20% each, we've got 20.2% returns. Now let's do the portfolio risk using weighted average. I'm going to do the same thing, 12% into 20%. Enter. I'm going to drag the formula down here, and I'm going to copy the sum function here, and we got a risk of 11.4%. So by allocating 20%, the portfolio return is 20.2% and the risk is 11.4%. Let's calculate the Sharpe ratio. Let's assume risk-free rate is 3%. So for us to calculate the Sharpe ratio, we first need to remove risk-free from our returns. I'm just going to remove that, and then we're going to divide this number by the risk. And we got the Sharpe ratio as 1.51. Now, this number is something that we received by doing equal allocation. Now, what is the way that we can maximize the Sharpe ratio and get more returns and low risk? Is there a way how to do it? Yes, we need to use the Excel function called solver. I'm going to show that how to use it. If you do not have solver installed on your Excel, there is a link that I'm going to post in this video how to enable solver function. You should be able to use the solver function by watching that video. For now, I have already enabled the function here. Let me go to data, and here it is. I will show how to use the solver function. Before I show you the solver function, let me just make small changes here. Let me cut the word total here and put it here, and I'm going to sum all the allocations because we want to make sure the sum is always 100%. Okay, now let me launch solver. Solver is nothing but we are going to throw a problem at it, and it's going to solve by changing the variables. Okay, Excel is going to do that automatically. You see here solver parameters set objective. What is objective for us? We have to increase the Sharpe ratio. So I'm going to select the objective cell reference here, And the objective, I'm saying maximize this number. This is what we're going to do here. And how do we maximize the number? What we're trying to tell Excel is change these variables, change these allocation numbers. We're going to give the reference to these cells. We're telling change these variables to maximize this number. And there is a constraint we have to always keep in mind. What is that constraint? That sum of all these numbers should not exceed 100%. Okay, it should always be equal to 100%. It's not exceed 100% or lower than 100%. The sum of allocation should always be equal to 100%. So we are going to set this constraint here. We're going to click add. Reference is this. And we are going to change the variable equal to, and then we are going to say 100%. And then we would say okay. It got added here. Make unconstrained variables non-negative, meaning we don't want the allocation to be non-negative number. It is okay if it can be 0%, but it cannot be non-negative. It doesn't make sense. So we need to make sure this box is checked. This one, leave it as GRG non-linear. That's fine. We're going to click solve. Let's see. Basically what Excel is trying to tell us is, instead of allocating in any of the stocks 1, 2, 3, 4, it's better you allocate 100% here so that you get maximum returns. If you do it here, you're going to get 35% returns and 11% risk. Excel feels these stocks 1, 2, 3, 4 are not a good option to invest here because you're not getting the maximum returns. Okay, see, it is not the case always. It is not the case always. If this risk is higher, then it will give you a combination of numbers. Since we have taken a random example, Excel solver is telling us top 5 looks pretty good. So it's saying, you're getting a Sharpe ratio of 2.91. It was 1.51 before. Just by investing all your funds in this particular stock, it's going to be the maximum return and the low risk, and it is also giving you a Sharpe ratio of 2.91. which is a very good Sharpe ratio. So this is how you optimize the portfolio. Okay. There is one more thing that I want to show you. Basis the logic that we have built here, I have completely automated a sheet wherein if I quickly give you a walkthrough of the sheet, you have dashboard, you have input sheet, you have calculation sheet here. Input sheet is nothing but you can choose different stocks. For example, you see S&P 500, Apple, Microsoft, Google here, right? These are the stocks that I pulled from investing.com. I pulled their monthly numbers. I copy pasted it here. I put the dates here too. Okay. Now, once I copy it here, all I have to do is I have to click on reset first. What it is doing is it's doing equal allocation. Then I click solver, click OK. Now it does solve the problem for us. Like it is saying invest 14% in Apple and 86% in Microsoft. That's going to be best optimized portfolio investment for me to get maximum returns with a low risk. There is a small modification that I have done in this Excel file. In this Excel file, instead of using the individual risks, what I have done is I have taken a covariance risk. Covariance risk is nothing but I'm just trying to compute the risk of each stock compared with other stock. This might look a lot complicated, but don't worry about that. The logic is very simple. Instead of computing risk only for S&P 500, Apple, Microsoft, Google, Amazon separately and doing a weighted average, what we're trying to do here is we're just trying to compute the risk of one stock compared to other stock, what the risk is going to be. And this theory is called Markowitz optimization theory model. And this is not in the scope of this video. And you really don't have to worry about any of these calculations, the formulas that I have built into this file. What you can do is simply download this sheet. You can use it for your personal reasons. If you like it, please give me a thumbs up. Please subscribe because your subscription means a lot to me. I'm just trying to develop my user base. However, the topics that I teach are a little complicated. Not everyone likes it. but whatever the user base I'm trying to build, I believe it's going to be a lot educated, a lot mature audience that we are going to build here. Please be part of our community, and I appreciate the time that you spent on learning this. It's going to be really helpful. If you really want me to make a video how I develop this entire file, I'm happy to do it. Thank you so much, and you can find the links in the description below. You can just use the sheet. The sheet can accommodate up to 11 stocks. So it auto computes all the numbers. You just click first reset and then click solve, click OK. It'll tell you the optimized numbers for your portfolio. You can use it for real life purposes just to get an idea, but don't depend on this file for your investment. I'm not an investment advisor. I'm just trying to teach you the subject.